Ladies and gentlemen, a warm welcome and thank you for coming along today to hear this discussion about Hong Kong's capital markets and also hopefully to produce some ideas with our help, the panel's help and your help, about how to set ourselves up for the exciting times ahead. We've got a very experienced panel here. You've seen the CVs, so I'm not going to repeat the CVs, but as they say that little piece, I'm going to introduce them, but we're lucky to have them here. Now, the financial sector in Hong Kong is obviously one of our pillars. I think it's, along with the other professional services, legal profession, the medical, the educational, the journalistic profession. This is our main, I think this should be our key competitive advantage in this part of the world. And so it's vitally important we get it right. My name is Richard Winter. I've been here since 1985. I came as a forensic accountant investigating the collapse of the Overseas Trust Bank. I'd love to write a book about that. I learned more about Asia than you can imagine. Then I joined Standard Chartered, stayed there for 12 years, and finished up as heading investment banking in Northeast Asia. After that, I helped two others. Together we formed the Quam Group, and we built it up into a financial services company of, I think it was about 300 or 400 people, and we sold it to China ocean-wide. And that was in 2017. A lot of things happened since then, but we bought ourselves back last year. And so now we are proudly a Hong Kong-centric, Hong Kong-owned, listed company we're not anything else, we're just Hong Kong and the region. So we have here Stacey on my far side. Stacey's president of the newly formed Capital Markets Practitioners Association. Stacey's been involved in corporate finance all his life, or most of his life. He's done every transaction you can imagine. Stacey's also on the advisory panel of one of the Cyberport committees. Arnold here he looks like a university student. It's hard to believe. He's actually been doing this for 30 years. I didn't think he was 30. This is what yoga does to you. He's owner and chair of his own company, which is called Altus. They are very much mid-market professionals. He's also much involved in the REITs, which we'll talk about later, and also regional businesses. And then Dr. Renu Bhatia, the hint is in the word doctor, is a financial professional, but also healthcare, and involved in innovation and technology. And so that's our panel. We're going to speak for about 20 minutes, and then we're going to open it up to everybody. So I hope you'll have your searching questions. So just to give a bit of context, the index, as you know, has fallen from the dizzy heights of something like 28,000, the Hang Seng Index. It fell down to less than 15,000 over a period of time. It's picked up its skirts recently, and I think I did look today, it's about 18,500. So it's had a bit of a roller coaster ride. Now I've given many talks like this to the university, etc., when I was doing sponsorship. We were always in the top 3 worldwide for sponsorships in Hong Kong, but we fell. And last year, last year we're 10th. Now we do have a lot of listings coming up, so we may well pick up our skirts, but that's a profile we need to discuss. GEM has struggled. GEM hasn't had I don't think it's had one listing quite recently, since 2021. I was very much involved when it was formed. GEM was meant to be our market for emerging companies, and it's struggled. So one of the subjects today is what can we do to make it better. The excitement is we're sitting on the crest of a wave, I think, and that's why I'm not going anywhere. I've been here for a long time, and I'm very excited about what's ahead of us. We're very fortunate to be part of China. China's got a growth rate of 5%, which is one of the tops in the Western world. Hong Kong itself last year grew by 3.3%, and this year is hoped it'll be between 2.5% and 3.5%. We've got a pole position in the Greater Bay Area, which has a GDP of 14 trillion, which is equivalent to Italy or Canada. I think we're in the top 6 economies in the world. This is just the Great Bay Area, and here we are in pole position. Hong Kong has had a big push to get family offices. We've now got 2,700 family offices. It was extraordinary. We've got 9,000 companies in Hong Kong, which have got the headquarters elsewhere. So we are an international center. Assets under management, you know, we all hear about how marvelous Singapore is, etc., but our assets under management are $3.5 trillion. And there's another 40 billion coming now. So things are exciting. The tangibles we have are obvious and often discussed, like the rule of law, or about, you know, no foreign exchange controls, etc. And they're terribly important. But the intangibles, which are not often expressed, I think are even more, just as important. For instance, we have a very, what's the word for it? Congenial society here. You know, we don't have any religious tensions. We don't have fights between Jews and Muslims and Christians and atheists. We all get on well together. We do cooperate, actually, and you only realize how well we cooperate is when you go elsewhere and you realize how nice this place is to live. I mean, I brought my family up here. My son's sitting here and my grandkids are here. And at my son's school, we worked out there was 50 nationalities at the school. 50. I mean, that's pretty special. And so it's terribly important we keep that going. So without more ado, I'd like to start to ask I didn't mention Science Park and Cyberport. We don't hear too much about them, but actually the figures coming out of those institutions are extraordinary. We have a lot of embryonic companies who need a place to raise capital. So we have to make sure we are here to satisfy the needs. So there you go, that's my view of life. So I'm going to start off with Stacey on the far side. So Stacey, will you just try and summarize where we are?
Okay, thank you, Richard. I've been given the easy part to give a general picture of where we are today. It will involve a lot of facts and data. Not a lot, but facts and data. Nothing really intellectual nutrient for you, for your liking. I will leave that to my reference host and my esteemed panelist members. So the last couple of years were bad. You know, the Hang Seng Index dropped from a recent high of 30,000 points in June 2021 to a low of below 15,000 points in October 2022. Rebounded a bit back to 22,500 points. And then in January, and then it slid to, again, below 15,000 points in January of this year. Not just an index, but in terms of overall turnover, in 2023, the daily turnover of the Hong Kong stock market is 105 billion, compared to 125 billion in 2022 and 166 billion in 2021. So we slid a lot. The northbound, which is part of the Stock Connect, people buying A shares through the Hong Kong market, experienced an outflow since August of 2023. The daily turnover of the Hong Kong stock market actually fell below 100 billion since September 2023 to February 2024. So all things are not well. 2023 was brutal. The Hong Kong stock market managed to drop 18%, whereas all other major indices recorded increases. So what was not right? So this is something that probably we will try to help to give some insight into later on. So at the turn of the year, we were given some hope. The Chinese government announces various measures to boost market liquidity. And that gave some momentum into the market. The northbound changed from an outflow to an inflow from February 2024. The market daily turnover crept back up to above 100 billion from March 2024. And the southbound inflow increased from about 1 billion. The net inflow increased from about 1 billion to 4 billion. from March 2024. So we are seeing some hope. And we were given further, impetus when the this Chinese Security Regulatory Commission announced on 18th of April closer ties with the Hong Kong Stock Exchange. And at the same time, the bulge brackets started to state that the Chinese stocks are way undervalued. So that increased a host of liquidity back into the market. So from 19th of April, the day after the announcement of the closer Chinese ties, the market rebounded from 16,400 points to 19,600 points on 20th of May. Now it's hovering around 18,500 points. Not just that, but the daily turnover, average turnover, increased from 19th of April to 31st of May this year, increased to 137 billion, which was higher than the daily average of the last 5 years apart from 2021. So we are seeing more hope. We are seeing the brighter side of things, but we are still way off our heyday. So it's not enough. What else has to be done? I will leave it to my panelists to help share their thoughts.
Okay, Arnold. So Arnold specializes in mid-markets, as I said, in REITs, and he's been here a long time. And so Arnold, what's your view? What are your observations and any suggestions to make this place even more attractive?
Actually, I'm quite optimistic about Hong Kong. I've grown up in Hong Kong. I've worked here for many years. What we do today at my company is completely different from what we were doing, or I was doing for Richard, who is my ex-boss in the 90s, when we were at Standard Chartered. So the market keeps changing. I think, first of all, we have got to recognize that things will keep changing. What we were doing in Hong Kong's heyday won't be what we will be doing in 5 years' time or 10 years' time. It'll be very different. Can we predict what we will be doing? It's very difficult. But what I love about working in Hong Kong is that we, and I'll come to that, making a small comparison with Singapore, because we are, in Hong Kong, are able to adapt. We are encouraged to adapt, and we can actually adapt. Hence, the Hong Kong market keeps changing. I don't think we need to look back to what we were doing 10 years ago. We need to look forward to what we can be doing. And what is great about the current moment is that everybody is worried. What is wrong with Hong Kong market? Can we get back to our heyday? And everybody is getting together to talk about this subject. This is what is encouraging. Even within our industry, last year, Stacey and I were involved in the formation of an association of Hong Kong capital market practitioners. And this is exactly what we in Hong Kong, the Hong Kong mentality, the people here the people working in Hong Kong are able to do. We actually look after ourselves. Making a comparison to Singapore, when we were trying, I was managing funds in Japanese real estate, and we were looking for a listing either in Hong Kong or Singapore, and being a bunch of Hong Kongers, we went to the Hong Kong regulators, and one department asked us to go to another department, so we didn't really know what to do. We went to Singapore, and the beautiful thing about Singapore regulators is they are so focused. We want to develop our REIT market in Singapore. Come, come, come. We can bend the rules. We can do this and do that. So we ended up being the first Japanese REIT listed in Singapore, and we were very happy. But the mentality in Singapore is such that it is all driven by government. There is very little room for imagination, room for adaptation to market changes. Came the global financial crisis after our REIT got listed. We needed to refinance the portfolio's loans, and hence we went to every single Singapore broker. But all the Singapore brokerages were out of business. They were sacking people. So we had no brokers to underwrite, and then we went to the regulators in Singapore say, look, we have to underwrite it ourselves, otherwise we're going to go bankrupt. And the regulators basically said, no, you can't do that, it's against the rule. And we said, no, it's not against the rule. And thanks to a very brilliant Singapore lawyer, who is now actually in exile, she managed to argue with the regulators and say, look, this is within the rules, you can do it. So this group of Hong Kongers, fund managers, we managed to reach out to all our shareholders and underwrote our own rights issue. At around the same time as HSBC did their rights issue, Standard Chartered did their rights issue, DBS did their rights issue. So that's how we managed to survive. So the mentality, I think I'm trying to say, is very different. And the fact that we in Hong Kong at this current moment, which is a sort of crisis moment for many of us here, is recognizing the problem and is able to get together and try to do something, is actually a very positive sign. And not only that, regulators in Hong Kong, their ears are open, they are listening to us, they're listening to our feedback. There's a lot of communication.
Single or plural?
Sorry?
Single or plural?
Both.
Regulators. And legislators. And they are listening to a lot of industry voices. So this is why I'm optimistic about Hong Kong. Granted that we are in a crisis situation, it's difficult to distinguish how much of that is because of the overall slowdown in the Greater China economy and how much of that is because of structural changes. As far as structural changes are concerned, we need them, but I'm positive and I'm optimistic that sooner or later we will be able to do that because of the way we operate here.
Good, thanks a lot. I'm going to ask you all, when we go around again, to come up with your ideas about changes, including you, Stacey. You're not off the hook. Before I do that, Renu, you are a specialist in healthcare, etc. Can you give any general comments about the market here for your industry?
Sure. Let me just, first of all, I am a physician by background, having a company of my own in Science Park, so I'm well aware of the challenges and the potential of having a startup in a very technical field in Science Park and the funding issues around that are available to these startups. But I've also been in finance for a long time at Goldman and at asset management. So let me pick up on something that you just said, which was that essentially there have been difficulties in the market. They've been outlined in quite a lot of detail already. But some of them are to do with the slowdown of the economy in China. We are very linked with the Chinese economy, but also the headwinds that are coming from on the geopolitical side, from whether it's Europe or the United States in terms of tariffs, etc. But I think the other part of it is it's also that I think perhaps is less widely recognized. If you look at our index now, more than 20% of it is in technology and the new economy. And if you just look across the world, technology companies have going through a major shift. So even if you were looking at the companies in Europe or the United States, they've all been retrenching, they've all laid off people, and they've also suffered some downward pressure on prices. So to some extent, that is factored into the Hang Seng index as well. But I think while it will take some time for some of these bigger macro issues to sort themselves out, I am very positive, and I think Hong Kong Exchange has done a number of things over the last few years in order to make the markets much more attractive for issuers to list, as well as giving a greater number of opportunities for investors as well. And they have borne fruit. I mean, if you go back, end of 2018, Chapter 18A came about, which was designed for pre-revenue biotech companies. Close to 85, 90 companies have listed on our exchange since then. That would not have been possible without the changes that were brought through. Weighted voting rights came through. We've seen 2022, we saw the SPAC regime, Chapter 18B, come through in order to, give companies looking to do something in that area a potential to do that. And then last year, we introduced Chapter 18C, which is for specialist technology companies, which do not meet the requirements both from a revenue or profit or a cash flow basis in order to give them potential to list. This, I think, is a true recognition of the fact that economies are evolving, and with the new economy type companies coming through, we need to have a listing regime that allows them to potentially list here without necessarily meeting the same kind of requirements that were initially for the main board. During that time, I think the exchange has also taken a look at the GEM and reformed some of it. GEM has been in existence, but Richard knows this way better than I do, but for a long time, and recognizing the fact that it needed some reforms to make sure that it is fit for purpose from both the issuer's perspective as well as the investors. A number of reforms were put through that only came into effect beginning of January, which to have been met positively by the market. And we've seen the first company list, I think this week, and there are a number in the pipeline. And if you look at Chapters 18C, there's a number in the pipeline too, as well as I think 6 SPACs were done when it came out. Now they will be looking to de-SPAC sometime later this year. So I think from a structural perspective, which is what we could do locally, I think the exchange has been fairly proactive in making sure that we are ready for potential companies to come. The exchange has also recognized several new exchanges from around the region, for example, Tadwal from Saudi Arabia, in order to be able to have the regime ready so that if there were secondary listings looking to come out into the market and tap into the economic potential and brand recognition in this area, then the regime has already been set up so that there is no impediment at that point to say, well, we cannot look here because we're not really figured all of this out yet. So I think from a structure perspective, I think the exchange has done a fair amount. Obviously, we are, the other part of the issue is that, different regimes have come through in China itself. CSRC came about and said that they will be needing to look at any companies that are going to go out, list outside of China. So that also has some bearing on the number of listings that have come out. But if you look at I think from an issuer perspective, the exchange has done a lot, and I think that's what you would expect from a time when the macro conditions are very different in order for them to make sure that the regime, the listing rules, have been put in place that are fit for purpose for the new economy companies that are coming to potentially list here.
Yeah, thanks. I'm going to open it up for questions fairly soon, but I've just got a couple of questions. Arnold, can I ask you something? There is a view amongst practitioners that the exchange is a bit of a one-trick pony, and it loves big caps, and it loves properties, and it loves traditional industries, but for mid-caps and small caps, it's a challenge. For instance, the minimum market cap that you need to have to list here is 500 million Hong Kong dollars. And I did a bit of an analysis the other day in the office, and if you look at the existing companies on the main board, and you gave that $500 million threshold to them, I think something like 40% of them wouldn't qualify. And the other rule we have at the moment is profits. I think the most recent year is 35 million requirement. If you do the same analysis for those companies, I think it's almost 60% would not qualify. So these thresholds were put into place in better times. And that's one point I want to raise. But in general, and then you mentioned something to me the other day. You said, what do we want? Do we want 10 mega companies listed here, or do we want 100 mid-caps? Because it's the mid-caps who actually join clubs like this, pay the rent, and take taxis, eat in restaurants. You know, the big guys, they don't. I mean, a lot of them, their business is not here anyway. It's just a technical listing. So we really, I think, we really have to put a bit of effort into attracting mid-caps and small caps and not treat them as second-class citizens. What do you think about?
Definitely. I think if given a choice whether we want in Hong Kong one company raising 30 billion US or 300 companies raising 100 million US, if it's either one or the other, I think definitely for Hong Kong status as an international financial center is the latter. But of course, we want both. Okay? And that is what you said is, the reason is the latter choice gives us depth of the ecosystem. The lawyers, the regulators, as well as the bankers, the brokers, the fund managers, the analysts. It's far better depth of the market than just one big company. And I think, of course, we want to encourage both types. And what we are going through now is actually a situation which is a catalyst, which encourages us to rethink what we are here for, what is the market for. So, for example, what Richard, you have just stated, some of these rules are quite, my personal views are quite archaic. What's the point of having a fixed number for a market cap? Because market fluctuates, economies fluctuates, profits fluctuates. So I think all the reforms which we need, or the sort of thinking which goes behind the reforms which we are going to have, will have to be very focused on who are the stakeholders of the stock market, or of the financial market. The stakeholders are not just the investors. We have placed a lot of importance on investors' protection, and that's quite right. But it's not just the investors. It's also the issuers, because the issuers are those coming to the market to raise funds to develop their business. Some of these businesses become very successful, some of them fail, but that's how business works. So all the stakeholders, investors, the business, the professionals, all the reforms, whatever we think need to be changed, we have got to ensure that we have a balanced approach to see how they impact all these stakeholders.
Yeah, thanks.
Richard, can I just follow up on some of the points that Arno made? First, the Singapore government's involvement, which I think, in Hong Kong, obviously, I think the government has to work with the regulators in order to have a balanced market, and also the government has to motivate the regulators to achieve or to develop the market. I don't know. When we were in the Asian financial crisis, the government stepped up with the tracker fund, buying a lot of shares, reestablishing confidence in the market. It hasn't done so this time round. When we were facing so much difficulty in attracting liquidity, I wish that the government had done more in coming into market directly, if it can, and also guiding the market in a positive direction. So that's one of my my thinking, my thought.
Yeah. Can I ask another question for anyone, but mainly you? Are we doing it? We're in an exciting moment in time. We're in such a fortunate part of the world. We have fintech, we have green tech, we have space tech. I mean, Hong Kong, space tech, nobody even knows what it means. But it's the drones, it's the satellites, it's leasing out to these companies. We have a lot of capability in our universities here for space tech. So there's a crying need to have a capital market which can service these areas. Green tech, as Renu said, STS are special technology companies. But are we doing enough really to service them? For instance, we're very pleased to have STS on the agenda as one of the chapters. But the minimum market cap for ST special, what they call special technology companies, is $8 billion. This is if it's pre-revenue. If it's post-revenue, it's 10 billion, I think, isn't it? So these are high figures. So basically, we're saying, yes, you can come with these new technologies, but you've got to be big. Now, is that right? I mean, because these companies coming out of cyber port, science park, etc., they won't be in that category. So is there anything else we could or should be doing to actually service this demand?
Well, you're right. Science Park and Cyberport, etc., and the government has done quite a lot in terms of encouraging the entire ecosystem. You know, companies that require a lot of R&D don't just sort of happen. They need both government funding and private funding in order to get to the point where they could potentially list or be a strategic buy for other companies. If you take any biotech company, you know, the life cycle to get a drug to the market is going to be closer to 10 years, requires enormous amount of regulatory hurdles that they need to cross, and need tons and tons of money. They just do. So I think the government, you have to do it from the top end, which is you need to provide a potential listing strategy, kind of an exit strategy for some of the investors that have been in there. But you do need to develop the entire ecosystem from venture capital to private equity, so all of these companies can then get to that. Cyberport is also developing that, but I think it does sort of take time, and there is, and that's what Chapter 18A, for example, was designed to do, to take a look at the fact that there are 4,000 biotech companies potentially in China at one point. There are a huge number in Science Park. You know, biotechs, material sciences, etc., are very well-recognized expertise at Hong Kong universities too. So you can see how these entrepreneurs could potentially develop and then develop those companies. So I think Chapter 18A dealt with some of that. Specialist Tech Chapter 18C was designed for something else. It's designed for the specialist tech companies which are in high applied materials, you know, semiconductor type businesses, or really at the forefront. Most of these companies tend to be big. They tend to be big. So you are going to potentially see them list here. And we do have some in the pipeline. But to your point, which is that, you know, we need lots of small companies and the big companies, I think you need both. And I think to be an international financial center, we need to be able to attract the larger companies too. Because the reason why you want to attract them is because with that comes funding. The institutional money then comes out into the region. Larger funds will come out. They will then look to invest in these companies. So the pool of investor increases, and the diversity of the investor base increases. If you don't have the larger companies, then you don't have the big institutional funds out there. And you do need them, because ultimately that increases the overall liquidity for the market. So I think it's a question of both. We want to encourage our own homegrown companies. We want to encourage middle-level companies, but we also want to attract the larger company in order to increase our investor.
Agreed. Actually, we need both, but previously, when the going was good, a lot of too much emphasis, I think, has been put on the big ones rather than the smaller ones, be it local or foreign. But definitely, I think, yes, we do. We need both for a healthy market.
Yeah, thanks a lot. Now, I've got a few more questions, but before I do, I'd like to just throw it open to the floor because we've only got 15 minutes left. So if you have burning questions, please mention your name and ask us.
Hi, I'm To Han Shi, Chief Analyst of Headland Intelligence. Arnold Ip says that what Hong Kong did as a financial center in the heydays in the past, it will not do in the next 5 or 10 years. Can you give us a clearer idea of what Hong Kong can do in the next 5 or 10 years that's different, that will keep it as a major international financial center?
Okay. What I was trying to say is we need to adapt. I have no idea how the next 5 years will evolve. What I know for sure, or with a lot of certainty, is that what we will be doing in the medium term will be quite different from what we used to be doing in the 90s or the noughties or the last decade. And that's a fact of life. But what we need to do in order to adapt is actually to keep an open mind and whatever reforms we come up with, whatever changes to the rules, whatever changes to the legislation, we need to ask what does the market need? What is the market for? Take into account all the stakeholders in the market, not just the fund managers, not just the companies, not just the retail investors, but everybody. Because Hong Kong is actually a very international place. It will remain so. I'm hopeful of that. And in a recent trip to Southeast Asia, a lot of Malaysian companies, and I can assure you that they have actually got very advanced technology and technological manufacturing type of companies. And a lot of them, they are looking to the Hong Kong market. But everybody says, oh, what's happening to Hong Kong? It's so expensive to get listed. It's so uncertain. I may spend 4 or 5 million US on professional fees without a certainty of listing. So these are the problems we need to address. And once we can address those problems, Hong Kong attractiveness will come back.
In addition to, Arnold's, I completely agree with Arnold's views. From my own view is that we relied on China as a hinterland, probably a little bit too much, so we should look at regional companies coming over to list, already listed, probably better, and other new products like virtual assets. The government announced virtual assets, want Hong Kong to be a virtual assets hub, but recent news say that a lot of companies pulled out from the licensing application because of difficulty in getting the licenses. So virtual assets, I think it's definitely something that we should focus on. It has various ties to financing, making it flexible. The other area that I think we can focus on is overseas RMB. See how we can manufacture more products and attract more capital coming in via these two new products. We all know that Chinese economy is not going to come back very soon. The Sino-US geopolitical tension will still continue for a couple of years. So I believe we need to look at new products.
Michael Somerville?
I think listening to that, I ask a question. Is there not a sort of conflict of interest between trying to serve these two areas? In terms of risk and reward for a major cap or for a major company, international company, and risk and reward for attracting the newcomer to the marketplace. In overseeing that, aren't you looking for a completely different set of values and therefore a conflict of interest?
It's a very interesting point you raise. In fact, I'm going to ask that question if I have time. The risk profile is different. And Hong Kong is not good at accepting a risk. Our regulators are risk averse. Singapore is different. Singapore, the MAS has two mandates. One is to develop the markets and one is to regulate. But our guys here are concentrating on the regulatory side. So that's a bit of an issue. So do we need another market which is specific for these new types of businesses and these regional companies which are coming up? Indonesia, for instance, is so exciting, and so is Vietnam, and so is the Philippines. There's many companies which are coming up and dearly need somewhere to raise capital, but is it appropriate we have them on the main board, or should we have a specialist board? Maybe we can come back to that point, because it's terribly important. Any other questions? This table's dominating the questions.
You're quite right. It's getting very urgent because once people leave, especially the younger generation, once they leave the industry, it takes a lot of convincing for them to come back. Once people leave Hong Kong, they might settle down elsewhere. It will take a long time for the professionals to come back. So it's very urgent. Can we speed up sufficiently to stop them from leaving the industry or Hong Kong? I don't know, it's anybody's guess, but we are seeing people leaving, which is why it's pretty much urgent for the Hong Kong market.
Question over here.
I know you're an expert in the Japanese market. Yeah. Do you think competitive currency depreciation is the key for Japan's economy turnaround over 30 years loss? Do you think Hong Kong will also consider about this as a way out? Because we over the 1 or 2 years, most of the Asian currency depreciate a lot, while Hong Kong still linked to the strong US dollar.
Okay, on the currency aspect, there are two aspects to your question. On the currency aspect, I think we have to ask Mr. Greenwood. But my personal view is it gives us a lot of stability and certainty. It can be good, it can be bad, but it is certain. Okay? But once we start meddling around with a higher rate or a lower rate could be better, then it opens up a lot of other possibilities, which can lead us to very uncertain and unknown areas. So my personal view is I prefer the certainty of a fixed peg. But on Japan, okay, I don't think the economy's development has got a lot to do with competitive depreciation. People are saying that it's trying to devalue. It is not. It's actually trying to support the currency. But US dollar interest rate has always been significantly higher than Japan in the last 20, 30 years. Why all of a sudden the yen has depreciated? There are lots and lots of theories about that. But looking at the Japanese economy, it has peaked 92. And then a whole generation and a half has sort of experienced a huge slowdown. But I have been going there for the last 25 years, and I can actually see a lot of subtle and very powerful changes, and I've noticed those changes in the last 15 years, I would say. But gradually, these are being publicized. For example, immigration. There's a lot of foreign workers there. Okay? People are saying the population is declining, and in 66 years' time, the last Japanese will switch off the light. No, there's a lot of immigration. Industry is changing a lot. The entire semiconductor industry is shifting back. So I think Japanese economy, I'm actually quite upbeat about that.
Can we get back to Hong Kong? We've only got 3 minutes left.
Sorry.
Can I just follow up? Oh, sorry, there's 2 more questions.
Thanks. Tony Watson from Far East Investment Management. Has any thought been given to rebuilding Hong Kong's position as an emerging markets finance hub? When I first came here 30 years ago, before China had really started to take off, this was the place in Asia where you came to get deals done in Indonesia, Philippines, Thailand, Malaysia, what have you. With China rising, of course, that just squeezed everything out, and you know the EM frontier theme just sort of fell by the wayside. Now, right now, globally, you really only have one EM and frontier hub, and that's London. There's nothing in this time zone. And while it is a bit of a moving target, I mean, when I came out here, Korea was basically an emerging market, not so anymore. But there are new emerging markets in the region starting to come up over the horizon. I'm going to Mongolia at the end of next week. I mean, I'm a regular visitor there. They now have all of the banks in Mongolia listed on the local exchange. A number of financial institutions, including the Mortgage Corp, which is modeled after Hong Kong Mortgage Corp, is a regular bond issuer. You have these opportunities. The ball is in the air. Do you want Singapore to grab it? Do you want Taipei to grab it? Do you want Japan to grab it? It's really an opportunity there, especially with China now moving off to the side. It's really an opportunity for us to grab. And I'm just, you know, again, back to my original question, has any thought been given to grabbing that ball and moving it down the field? Thanks.
Well, I think you're absolutely spot on. I mean, there's so many exciting things happening in the countries you've mentioned, but they're not really coming here yet. And we could spend another hour describing why, but we have to be open. I mean, my view is we have to be certainly encouraging us to be their natural choice of raising money, along with space tech and fintech and all the new industries which are cropping up. But to answer Michael's point, it's a different risk profile. And so is GEM up to that risk profile? If we wanted to try and keep the main board as it is, and it's been very successful, we don't want to knock it, but also complement it with what you've been describing, is GEM the right vehicle for that, which is a fascinating subject, but unfortunately we're 3 minutes too late.
On that, I have my own a little bit view. Risk, the investors calculate that risk. They are risk takers. They are people that are risk averse. On emerging markets, the exchange has been doing a lot of work, visiting like Cambodia, Indonesia, Malaysia, in an effort to attract them to come over to raise money. So I don't think the exchange has neglected the EMs, but it takes time for them to come. Like if there's a company or fundraise, a private company, the local government will try to convince them to raise the funds within the country. So we need to look at what type of companies, the maturity for them to come over to jump to a better board to raise funds.
Can I just add on that one? I think that the exchange has been extremely proactive in whether it's going to the Middle East or whether visiting, countries in the region. You also have to remember 20 years ago, 30 years ago, it was very different, the landscape that we're looking at. Every country now wants to develop its own financial services, if I can just put it broadly in that way, themselves. You know, if you were to be an Indonesian company and you were a successful company and you said, I'm not going to list on the Indonesian exchange, it would be very difficult to, for the government, the Indonesian government or the Dubai government or Singaporean government, to say, no, that's okay, you go and list in Hong Kong. I don't think, and that's why I think the tact that the thing that the Hong Kong Exchange is doing is basically saying, we're looking through the various exchanges that are out there on which these companies can already list in their home markets. But we want to make sure that if they're thinking of potentially raising further capital or having a secondary listing, then we need to be ready in order to do that. And it is very attractive. And to a point, it is true, they will tend to be the larger companies. in order to have either a secondary listing or a dual listing because of the complications of having, listings in different markets. Now, once you do that and you then get into the Hong Kong index, Hang Seng index, then you have the possibility to be part of Stock Connect. And that is one huge benefit that we have, because once they're in Stock Connect, then obviously they are able to be invested in by mainland investors. So I think that very positive attribute, that message, is what the exchange and everybody else has been going out and explaining. But I think, every country wants to develop their own exchanges. I mean, if you look at Ghana, there has about 9 companies listed on it. But they want to develop that. They want to find, local exchanges to have their primary listings.
Good. We've been granted a 5-minute excess by Chairman Lee here, which we've exhausted now. So I think we'll have to bring it to an end. But we can carry on chatting. We're here. And I hope we do carry on chatting. It's raised some very interesting points. I'd love to repeat this every month. Anyway, thank you very much for coming indeed. And thank you, panel.
Thank you.